Joining us now, John Kinsley, Managing Director of Prudential Portfolio Managers Unit Trust. Thank you so much for joining us, John. Let's start with the Prudential Balanced Fund. And again, the underpin here is about capital preservation. I'm going to put it to you on that front.
Yeah, Bronwyn, I think the key issue here is if you look at the flows that have been taking place in the unit trust sector, the real flows other than to short-term money market funds have been into asset allocation type funds, either low equity, sort of inflation plus 4 or 5 targeted funds, or inflation plus 6, 7, the higher risk type of funds. And having said that, we believe that the most important thing for an investor long term, and I've heard I sat through some of the earlier commentary this evening, and sure, markets are looking a bit wobbly, and the man in the street very often just doesn't know where to go. And what we try and say to them is, first and foremost, don't panic. There's a lot of noise out there on any one day. And the most important thing you can do is, one, determine what sort of return you require long term, be it inflation plus 3 or inflation plus 6, 7. And once you've done that, together with an advisor or whoever you're talking to, you can then decide what sort of asset allocation over the long term will best support that. And to us, that's the most important long-term decision an investor will make.
John, if you look at the breakdown of your fund at the moment, you're sitting with around about 45%, it looks like, in equities, but then you've got quite a big allocation on top of that to global equities of around about 24, 25%. So when you put that together, you're in the order of 70% exposed to equities, either locally or globally. Do you think that's, I mean, obviously you think that's appropriate, but isn't that a little bit high risk in the current environment and in an environment where you're talking diversification?
Yeah. Kevin, I think it's a good question. I think that the important issue here is that the investors in this fund are targeting a real return, so that's above inflation, of 6 to 7% over time. Now, in order to attain that, one has to accept the fact that you need risk assets to do so. It doesn't mean that you are irresponsible about your asset allocation. So what we've done is that we tend to build, much like the previous speaker, we're a value house. We build our underlying building blocks, if you want to call them, from a bottom-up perspective. But when we allocate between the different asset classes, we do a lot of relative valuations. And if we look around the world at the moment, our view is that most probably the cheapest asset class for the average investor is global equity, and particularly in developed markets. Now, it doesn't mean it's risk-free, but we believe we are being more than compensated for some of the risk in those markets. So over a longer term, we would tend to have about 50 to 55% in South African equities and maybe about 15% in global equities. At the moment, you'll actually find that we've swung that around a little bit, and we're right down to 45% in South African equities, and we've overweighted our global equities to 24, 25%, because that's where the valuation lies, and that's where we're being compensated for the risk that we're taking.
John, can I ask you, is that a fairly recent move? In other words, has that been a decision that you've taken during the course of this year to increase your offshore allocation? And if so, how do you argue that relative to a view that says maybe the rand can remain at current levels?
Kevin, we took the position sort of in the third to fourth quarter of last year. So we were right up to 25% going through into December. And let me just say that from a point of timing markets, we don't believe we're better than anybody else. Timing markets is really a mug's game. But it was a valuation-driven decision. I'm happy to say it's panned out quite well. Having said that, the issue of the rand is not the primary driver. One must look first and foremost at valuation. And that's what drove us to look at those markets and to move more offshore. It doesn't mean that we find South African equity totally unattractive. At best, we think it's about fair value. There's some good pockets of value, but as a market as a whole, it's about fair value on a forward earnings yield of about 8 times, or 8%, on a multiple of about 12.5 to 13. So it's about fair value. But international markets, particularly developed markets in Europe, are a lot more attractive. So that was the primary driver. If we can get a second or double whammy, as we call it, with a bit of rand weakness, that's fine. But trying to predict that is impossible. At best, we would argue that on a purchasing power of parity level, as one of the earlier speakers said, it's most probably slightly overvalued. But your guess is as good as mine as to when, in fact, it'll go back to some form of equilibrium.
With your SA cash exposure sitting at 11.2%, is that relatively high in terms of your general standard where cash holding is concerned?
Yeah, Bronwyn, that's purely a function of flows. we've had some fairly good flows into a couple of our what we call multi-asset class funds. And so as those funds come in, we don't necessarily have to apply them immediately. I think you will find that will begin to come down, because our view would be that of all the South African asset classes, cash is the most unattractive. It's one thing if you've got a 12-month horizon, but if you're trying to invest longer term, the current yields on cash are most unattractive, and in fact, after inflation, are negative at the moment.
Does that, John, does that apply equally to your holding in fixed interest instruments? Earlier on the show, we were talking to Andrew Cantor, was saying that he wouldn't find much value in global bonds, but he was saying in the local bond market, he thinks there's some value there. Your holding in fixed interest instruments seems to be quite low. What's your sense about the bond market?
And just for viewers out there, sitting currently at 14.9% in terms of fixed interest exposure.
Yeah. In terms of global bonds, I would endorse Andrew's comments that our view would be that international bonds are not attractive at the moment. Certainly global sovereign bonds not attractive. There might be some space for international corporate bonds, but not in this fund. We believe we can get a better bang for our buck, as it were, in equities than in corporate bonds. So this fund is not holding any offshore, any global bonds, either sovereign or corporate. In terms of local bonds, we've held about a neutral weighting there. And I would tend to agree with Andrew that at about 8.5%, we're fairly ambivalent about South African bonds. With inflation at 5.5%, whatever you want to call it, and a yield on 10 years at 8.5%, you're looking at about a 3% yield. It's not wildly attractive, but it's more attractive than cash. So you might well find that as we begin to deploy some of that cash, we'll move it across into some of the bonds and also into property.